The most dangerous part of a bubble is not the beginning. It is the moment when everyone feels smart again. That is the point I want to start with, because too many people still think risk feels like panic. They think danger announces itself through red candles, screaming anchors, and a market that is already obviously broken. That is not usually when ordinary investors do the most damage to themselves. They do the most damage right after the fear fades a little, right after the index makes a new high, right after the market shrugs off a war scare, right after the most reckless names start flying again, right after the public decides the crisis was overblown, and the next easy money wave has already begun. That is when discipline matters most, because that is when people stop wanting to be safe and start wanting to be included. And inclusion in markets is one of the most expensive emotions there is. Right now, I think we are in one of those moments. The S&P 500 is printing all-time highs. Crypto has regained its swagger. Dividend ETFs are quietly doing very well. The Strait of Hormuz is open, depending on whose version of open you prefer. A month ago, people were talking like the next depression was around the corner. Now, a large portion of the same crowd is behaving as though the market has already received full clearance from reality itself. That is exactly the kind of transition that should make a serious investor sit up straighter, not relax. Because markets are not the most dangerous when everyone is afraid. They are often most dangerous when fear is still justified, but enthusiasm returns first. That is the setup I think we need to respect now. Now let me be clear. I am not telling you to panic. I am not telling you to dump everything. I am not telling you the market cannot go higher. What I am telling you is more subtle and, I think, more valuable. We are seeing the kind of late cycle behavior that historically shows up when speculation starts overpowering judgment, when access to leverage gets easier, when valuation discipline gets mocked, and when the market begins rewarding the story before it has demanded the proof. That is never a comfortable thing to say in the middle of a rally. It is still the right thing to say. Let me start with the most obvious red flag because it is almost too perfect to ignore. Back in the late 1900s, the internet became the story. That story was not wrong. The internet did change everything. The mistake was not believing in the technology. The mistake was believing that every company touching the word internet deserved a market value detached from all earthly standards. And the mania became so absurd that companies with no business becoming internet companies simply added .com to their names and watched the market reward them for it. That is not innovation. That is narrative intoxication. The public did not care because the stocks were going up, and that is the defining feature of late-stage euphoria. The price becomes the proof. If it is rising, people assume that must mean the thesis is good. They do not ask whether the rise itself is creating the illusion of quality. Now look at what just happened in our own market. A shoe company decides it is. Now suddenly, an artificial intelligence company, it puts out a press release. The market reacts as though a divine revelation has just occurred. The valuation explodes in a day. Millions of dollars chase it. Very little about the real business improves on the spot. The chart goes vertical anyway. That is not a healthy market signal. That is a symptom. The symptom is not that AI is fake. I want to be very clear about that. AI, like the internet, is real. It will matter. It will change workflows, margins, labor, and entire business models. The technology itself is not the lie. The lie is the speed with which the market decides every AI. A Jason story deserves immediate capitalization as though the future has already been delivered in perfect form. That is what bubbles do. They take a real technology and pair it with fake timing. They take a good long-term narrative and turn it into a bad short-term valuation discipline. And they seduce intelligent people by hiding the difference between being right eventually and paying too much. Now that difference ruins portfolios. So when I see a company add AI to the story and the market adds hundreds of millions in value before the profits, the margins, the product economics, or the strategic evidence have caught up, I do not see confirmation. I see a warning, and I think it is an especially important warning because it tells us something about investor psychology that broad indexes alone will not. People are no longer just optimistic. They are willing to suspend disbelief that matters. Now let me give you the second red flag, because it is even more dangerous in my view, precisely because it will be sold to the public as empowerment. The gate around active day trading has been loosened. That sounds democratic. It sounds modern. It sounds like access. What it really means in practical terms is that a huge number of smaller investors are going to be given more freedom to behave like gamblers in one of the most emotionally unstable and narrative-driven market environments in years. This is not progress. This is throughput. Brokerages do not need you to win. They need you to trade. That is the part people still refuse to understand. A platform that makes money on activity benefits when you become more active. It benefits when you are excited. It benefits when you believe that the next vertical chart belongs to you if only you are quick enough, aggressive enough, and free enough to push more buttons with less friction. That is how casinos think. And a market is at its most dangerous when casino incentives and technology mania start feeding each other, because then you get the perfect storm. You get emotionally charged stories. You get high volatility names. You get easier access for undercapitalized traders. You get momentum worship. You get people confusing participation with skill. And you get an industry standing in the middle collecting fees, spread, order flow, or attention, while the public mistakes access for edge. That is not the same as financial inclusion. That is the industrialization of bad behavior. Now, I do think these platforms will make more money because of it. That part is straightforward. More turnover tends to enrich the house. But when the house benefits from customers taking more short duration risk with less restraint at exactly the same moment that speculative narratives are being repriced to the sky, the signal I receive is not bullish safety. It is late cycle froth. That is the second warning. The third warning is more subtle, which is why it matters more. The market S-surface is strong. The internals are less convincing. This is an old lesson, and one that newer investors tend to ignore because they are still hypnotized by the index level. If the S&P 500 is making new highs, they assume that means the market is healthy. Not necessarily. A market can rise on weak breadth. A market can rise on narrowing participation. A market can rise because a handful of large names are doing the heavy lifting while more and more of the underlying structure becomes brittle. That is why I care not only that the market rallies, but how it rallies. Was the move broad? Was the volume healthy? Were defensive sectors confirming? Were small caps participating? Were the gains built on real earnings power or on multiple expansion and speculative enthusiasm? These questions matter enormously because aging bull markets often become narrower before they become weaker. The public sees the high. The careful investor sees the narrowing road that led to it. That narrowing road is rarely a reason to become euphoric. Now let us add the fourth layer, which is the macro environment itself. The public has decided the Iran story is calming down because the words ceasefire are floating around and because the shipping lane is technically open. The public is once again trying to price the world according to the best available headline. That is not how real economic transmission works. The war story is not over because a television segment sounds less nervous. The oil shock has already moved through the system. This is what so many people keep missing. If energy spikes hard enough, it does not matter that the chart later pulls back. Some trucking companies adjust. Shipping costs adjust. Manufacturers absorb the first hit. Contractors get trapped on fixed bids. Housing costs inherit the damage. Inflationary pressure becomes embedded in places the public will not see until later. That is why I do not trust the relief too easily. A ceasefire can calm the story faster than it calms the system. And if the system is still carrying that cost through earnings, contracts, and supply chains, then the stock market may be celebrating before the underlying economy has actually digested the shock. That is not automatically fatal to stocks, but it is not something I ignore either. Now, layer the Federal Reserve on top of that. The Fed is sitting in a deeply uncomfortable place. If it stays too tight, it risks choking an economy already dealing with higher energy, linked costs, and weakening demand under the surface. If it eases too quickly, it risks letting inflation run hotter and devaluing the purchasing power of cash and wages further. That is the classic trap. And when central banks are trapped, markets often rise in anticipation of relief before the underlying damage has finished showing up in the numbers. That is why earnings matter so much here. The market is making a claim. It is saying that profits will justify today's enthusiasm. Fine. Then let us see the profits. Because if the biggest companies in the market, especially the dominant technology and AI-linked names, fail to support the valuations that current investors are paying, the repricing can get violent quickly. Bubbles do not burst because technology is fake. They burst because the gap between narrative and near-term financial reality becomes too large to carry. That is what happened in the internet era. The internet was real. The valuations were too early. The market paid for perfection long before the businesses could deliver it broadly enough. A few giants survived and became extraordinary. Many more got carried out. That is the pattern I see people refusing to respect. Now they hear caution and assume it means you are anti-innovation. I am anti-overpayment. Those are not the same thing. Now let me say something that will probably disappoint people who want a dramatic, clean answer. I do not think the right move is to go all in on fear. I also do not think the right move is to go all in on excitement. This is a time for discipline, not theater. And discipline starts with an unpleasant exercise. You ask yourself, what happens if the market drops? And not just drops once, but keeps dropping while your other conditions also worsen. This is where most households refuse to think. Honestly, they imagine the worst case as a chart problem. That is not the true worst case. The true worst case is a chain. The market drops, oil and living costs stay elevated, spending weakens, companies lose margin, layoffs begin, your job gets less safe, your debt payments remain fixed, your emergency reserve is too small. Now you are not just looking at a portfolio decline, you are looking at a forced seller scenario. You have to liquidate into weakness to keep your life functioning. That is how people get permanently damaged in markets. Not by having a stock go down, by needing the money when the stock is down and having no margin anywhere else. That is why I always sound repetitive about emergency funds and debt. People glaze over because those topics are not exciting. Exactly, that is why they matter. The market does not kill people who were merely unexcited. It kills the people who were underprepared. If you have 6 months of expenses, if you have little or no high-interest debt, if your life is not built on financial fragility, then a drop is an inconvenience and maybe eventually an opportunity. If you do not have those things, then a drop can turn into a life event. That is the difference. So my framework here is not heroic, it is practical. First, protect the base. Emergency savings. Kill the high-interest debt. Do not rely on optimistic assumptions about job security in a slowing environment. Second, keep investing, but do it the boring way. I still believe in broad market dollar cost averaging. Yes, even near highs. That surprises people because they think caution and DCA are opposites. They are not. Caution is not the same as paralysis. Dollar cost averaging into broad productive equity ownership while keeping your personal balance sheet strong is very different from chasing whatever ticker is going vertical because somebody added AI to a press release. One is ownership, the other is appetite. Ownership builds wealth. Appetite destroys people when it outruns judgment. So yes, I would still keep allocating to broad index exposure because over time the S&P 500 has kept making new highs and then new highs again. That is what productive capitalism does over long enough stretches. But I would do it with the mindset of a builder, not a gambler. I would not confuse long-term DCA with permission to ignore valuation froth, personal risk, or the possibility of a nasty drawdown. In the meantime, that is the distinction. Third, avoid greed. This sounds moralistic. It is not. It is structural. Greed in markets is usually just short time horizon plus inflated self-confidence. People see a market rising and decide they must press harder right when the environment is most fragile. They take the lack of immediate punishment as proof of safety. That is how people walk into the blast zone smiling. Right now, disciplined investors can still do very well. They can average into quality. They can keep broad exposure. They can hold cash reserves. They can preserve flexibility. They can let the bubble play out further without becoming its victim. The gambler cannot do that. The gambler needs validation now. The gambler sees the AI stock exploding and thinks, I must have that. The disciplined investor sees it and asks, what does this say about where we are in the cycle? That is a much better question. Fourth, watch the earnings, not just the headlines, not just whether a company beats. Watch margins, watch guidance. Watch CapEx. Watch whether AI is becoming real profit or merely a real expense, supporting a temporary narrative premium. Watch whether the Mag 7s still carry the authority to justify the whole market as optimism, or whether cracks start to show beneath the glamour. That will matter more than people think, because the market right now is making a huge forward bet. It is betting that the future earnings base of these companies will grow fast enough and clean enough to justify not only their valuations, but also the broad calm the market is displaying in the face of geopolitical and macro stress. If that bet begins to wobble, the repricing will not need a recession to start. It can start simply because expectations were too perfect. That is what late-stage bubbles do. They leave no room for being merely very good. You must be flawless or the stock gets punished. Now let me tell you the deeper pattern that ties all of this together late in a cycle. The public starts confusing access with skill. They think because technology lets them trade more, they have more control. They think because they can open an app, borrow intraday, and chase the name of the moment, they are operating closer to professional capital. In reality, they are usually moving further away from professional behavior, not closer. Professional behavior is framework sizing, risk management, diversification, patience. Knowing when not to swing. The public version of empowerment is usually speed, noise, and self-destruction. That is why I look at the removal of certain guardrails in a euphoric AI phase and see danger, not democratization. It is also why I look at crazy one-day revaluations on nonsense corporate pivots and see the end of a rope, not the beginning of a bridge. None of this means the market must crash Monday morning. It means you are seeing the kind of conditions that tend to appear before people get hurt, and because many of my viewers are not 25 with 40 years of earning power ahead of them, I take that seriously. If you are near retirement or in retirement or simply no longer playing the all-in growth game, then your job is not to catch every rocket. Your job is to make sure you are never forced into the wrong decision at the wrong time. That means cash reserves. That means no crippling consumer debt. That means boring broad exposure over heroic speculation. That means understanding that a market at all-time highs can still be dangerous if the road beneath those highs is becoming thinner and more unstable. And that means accepting a truth that the culture hates. Sometimes the best investment decision is not finding the next winner. It is refusing to become one of the losers. That sounds defensive. Good defense is underrated right before offense turns stupid. So let me leave you with the frame I think matters most. The market may keep rising from here. AI will almost certainly produce real winners. The broad indexes may continue rewarding steady ownership over time. All of that can be true, and it can still also be true that we are seeing classic bubble adjacent behavior, classic late cycle access expansion, classic narrative, over fundamentals moments, and classic signs that many people are about to learn the difference between investing and participating. I know which side I would rather be on. Not the side of the shoe company pretending it found a new religion. Not the side of the platform celebrating more day traders, because more day traders means more pain to harvest. Not the side of the investor who thinks a ceasefire headline repaired every cost shock already moving through the system. I would rather be the boring one, the one with emergency reserves, the one without bad debt, the one who keeps buying broad productive assets patiently, the one who respects worst-case scenarios without needing them to happen, the one who does not FOMO into the last loud phase of a story just because the chart was kind enough to look exciting before dinner. That investor rarely feels brilliant in the moment. He usually just feels patient, but patience paired with survival is how real wealth compounds, while the crowd keeps relearning the same lesson every generation. This is one of those generations, and I would be very careful about forgetting it, just because the screen looks green this week. There is one final reason I think this moment deserves real caution. Euphoria after fear feels like relief, and relief is one of the easiest emotions to misread in markets. People survive a scare, see prices recover, and then reinterpret the whole event as proof that risk was exaggerated from the beginning. They do not say, perhaps the market is still fragile. They say, I almost missed the rebound. That psychological switch is where discipline dies, and once discipline dies, people stop asking what they can afford to lose and start asking how fast they can catch up. That is the stage I never trust, because at the start of a sell-off, people are afraid. At the end of a sell-off, people are thoughtful. But in the rebound phase, before the fundamentals have fully healed, people become reckless and call it confidence. That is the most dangerous translation error in finance. So when I see the market making new highs, AI speculation regaining absurdity, trading guardrails loosening, earnings risk still ahead, and macro pressure still unresolved, I do not see a clean green light. I see a test of whether you are the kind of investor who needs a story to feel good before buying badly, or the kind of investor who can keep building methodically while refusing to become exit liquidity for somebody else. Excitement. That is why I still prefer the same quiet rules. Keep the emergency fund, kill the high interest debt, stay diversified, keep averaging into broad productive assets, let the gamblers entertain each other, and never confuse a market's ability to rally with proof that the underlying system has stopped being dangerous. Those are not the same thing. In fact, in late-stage cycles, they are often exact opposites.